Question 1. Stakeholder feedback indicates concerns regarding the potential environmental and social ramifications of Brookfield Corporation's proposed infrastructure development project in a sensitive ecological zone. The project team is under pressure to expedite the approval process and commence construction to meet market demands. Which of the following approaches best aligns with regulatory requirements and professional best practices for managing these concerns? Option A. Postpone the detailed impact assessment until after the initial construction phase, focusing solely on meeting the project's immediate financial objectives. Option B. Conduct a comprehensive environmental and social impact assessment (ESIA) involving independent experts, thorough stakeholder consultation, and detailed mitigation planning before seeking final project approval. Option C. Prioritize immediate construction commencement based on preliminary internal assessments, with a commitment to address any environmental or social issues that may arise during the project lifecycle. Option D. Rely on existing, general environmental guidelines and conduct informal discussions with a few key local representatives to gauge community sentiment. The correct answer is B. Conduct a comprehensive environmental and social impact assessment (ESIA) involving independent experts, thorough stakeholder consultations, and detailed mitigation planning before seeking final project approval. Explanation: this scenario is professionally challenging because it requires balancing the immediate financial implications of a project with its broader, long-term environmental and social impacts. The pressure to deliver a project on time and within budget can often overshadow the need for a thorough impact assessment, especially when the consequences are not immediately quantifiable or directly tied to financial performance. Careful judgment is required to ensure that all relevant stakeholders are considered and that the assessment process is robust and objective, adhering to regulatory requirements and ethical standards. The correct approach represents best professional practice because it prioritizes a comprehensive and systematic evaluation of potential impacts before significant project commitments are made. This aligns with regulatory frameworks that mandate impact assessments to identify, predict, and evaluate the environmental and social consequences of proposed projects. Ethically, it demonstrates a commitment to responsible development, transparency, and stakeholder engagement, which are crucial for maintaining corporate reputation and social license to operate. By proactively identifying and mitigating negative impacts, the company can avoid future liabilities, enhance project sustainability, and build stronger relationships with affected communities. An incorrect approach that focuses solely on immediate cost savings without a proper impact assessment would represent a significant regulatory failure. Many jurisdictions have specific legislation requiring environmental and social impact assessments for certain types of projects. Failure to comply can result in fines, project delays, or even outright cancellation. Ethically, this approach demonstrates a disregard for the well-being of affected communities and the environment, potentially leading to reputational damage and loss of public trust. Another incorrect approach that relies on anecdotal evidence or superficial consultations would also be professionally unacceptable. Regulatory requirements often specify the methodology and depth of stakeholder engagement and impact analysis. Relying on informal feedback without a structured assessment process can lead to overlooking critical issues, resulting in unforeseen negative consequences and noncompliance. This approach fails to meet the standards of due diligence and responsible corporate citizenship. A third incorrect approach that delays the impact assessment until after project commencement or only conducts it reactively would be a failure to adhere to best practices and potentially regulatory mandates. Impact assessments are most effective when integrated into the early stages of project planning, allowing for informed decision-making and the incorporation of mitigation measures from the outset. Reactive assessments are often less effective, more costly, and may not adequately address the root causes of negative impacts. Professional decision-making process for similar situations should involve a structured approach to impact assessment. This includes clearly defining the project scope and potential areas of impact, identifying all relevant stakeholders and their concerns, selecting appropriate assessment methodologies, conducting thorough data collection and analysis, developing clear mitigation and management plans, and ensuring transparent communication and reporting throughout the process. Professionals should always refer to the specific regulatory requirements applicable to the project's jurisdiction and uphold ethical principles of responsibility, fairness, and transparency. Question 2. Regulatory review indicates that a client has approached Brookfield Corporation with a proposal for a complex tax planning arrangement. The client believes this arrangement will significantly reduce their tax liability. However, the initial description of the arrangement is somewhat vague, and it is unclear whether it fully aligns with current tax legislation and relevant guidance issued by the relevant tax authority. What is the most appropriate course of action for Brookfield Corporation to take? Option A. Seek further clarification from the client regarding the specifics of the arrangement, conduct a thorough review of applicable tax legislation and guidance, and then advise on the compliance and risks associated with the proposed plan. Option B. Provide advice based on general principles of tax law, without delving into the specific details of the client's proposed arrangement or consulting recent guidance. Option C. Politely decline to engage with the client on this matter, citing the firm's policy against aggressive tax planning. Option D. Immediately proceed with the tax planning arrangement as described by the client, assuming their understanding of the law is correct. The correct answer is D. Immediately proceed with the tax planning arrangement as described by the client, assuming their understanding of the law is correct. Explanation. This scenario presents a professional challenge due to the inherent conflict between a client's desire for aggressive tax planning and the firm's obligation to adhere to regulatory requirements and ethical standards. The firm must navigate the fine line between providing legitimate tax advice and facilitating potentially non-compliant or aggressive tax avoidance schemes. Careful judgment is required to ensure that all advice is grounded in current legislation and guidance, and that the firm does not inadvertently engage in or promote practices that could be deemed abusive or non-compliant by the relevant tax authorities. The correct approach represents best professional practice because it prioritizes a thorough understanding of the client's objectives within the bounds of the law. By seeking clarification on the specific nature of the tax planning and reviewing relevant legislation and guidance, the firm demonstrates due diligence and a commitment to compliance. This proactive stance ensures that any advice provided is legally sound, ethically defensible, and aligned with the firm's professional responsibilities. It also protects both the client and the firm from potential penalties and reputational damage. An incorrect approach that involves immediately implementing the client's proposed strategy without further investigation fails to meet the professional standard of care. This would be a regulatory failure, as it bypasses the necessary due diligence to ascertain the legality and compliance of the proposed scheme. Ethically, it could be seen as complicity in potentially aggressive or non-compliant tax practices. Another incorrect approach, which is to dismiss the client's request outright without understanding their objectives or exploring legitimate avenues, might be professionally unhelpful and could lead to the loss of a client. While it avoids the risk of non-compliance, it fails to demonstrate a commitment to providing comprehensive and appropriate advice within the regulatory framework. It misses an opportunity to guide the client towards compliant tax planning strategies. A further incorrect approach, which is to provide advice based on outdated or ambiguous interpretations of tax law, represents a significant regulatory and ethical failure. This demonstrates a lack of up-to-date knowledge and a disregard for the current legal landscape, potentially exposing the client and the firm to penalties and sanctions. The professional decision-making process for similar situations should involve a structured approach. First, fully understand the client's objectives and the proposed strategy. Second, conduct thorough research into the relevant tax legislation, regulations, and official guidance. Third, assess the risks and compliance implications of the proposed strategy. Fourth, provide clear, well-reasoned advice that outlines both compliant options and the potential consequences of non-compliance. Finally, document all advice and client interactions meticulously. Question 3. Risk assessment procedures indicate a potential vulnerability in the firm's client data management system, specifically regarding unauthorized internal access. Which of the following approaches best addresses this operational risk in compliance with relevant financial services regulations? Option A. Relying on existing perimeter security measures, such as firewalls, to prevent external breaches, assuming internal access will be managed through general IT policies. Option B. Implementing a strict access control policy based on the principle of least privilege, coupled with regular security awareness training for all employees on data handling protocols, and conducting periodic, independent vulnerability assessments of the system. Option C. Conducting a comprehensive security audit only once every 5 years to evaluate the system's overall security posture. Option D. Granting all client-facing employees broad administrative access to the client data system to ensure they can efficiently assist clients with their inquiries. The correct answer is B. Implementing a strict access control policy based on the principle of least privilege, coupled with regular security awareness training for all employees on data handling protocols, and conducting periodic, independent vulnerability assessments of the system. Explanation. Scenario analysis. This scenario is professionally challenging because it requires an individual to navigate the complexities of assessing and mitigating operational risks within a financial institution, specifically concerning the integrity of client data and the potential for unauthorized access. The challenge lies in balancing robust security measures with the need for efficient client service and compliance with stringent data protection regulation. A misstep in this area can lead to significant financial penalties, reputational damage, and loss of client trust. Correct approach analysis. The correct approach involves implementing a multi-layered security strategy that includes regular vulnerability assessments, access controls based on the principle of least privilege, and comprehensive employee training on data handling protocols. This aligns with the principles of robust operational risk management and data protection, as mandated by regulatory frameworks such as the UK's Financial Conduct Authority (FCA) handbook, specifically CISC 8 on outsourcing and IT resilience, and the General Data Protection Regulation (GDPR), if applicable to client data. The emphasis on proactive identification and mitigation of threats, coupled with continuous monitoring and employee education, represents best professional practice by ensuring data confidentiality, integrity, and availability, thereby safeguarding both the firm and its clients. Incorrect approach is analysis. One incorrect approach involves relying solely on perimeter security measures without addressing internal threats or access controls. This fails to meet regulatory expectations for comprehensive data security and operational resilience, as it leaves the institution vulnerable to insider threats or compromised internal systems. It violates the spirit of data protection regulations that require measures to prevent unauthorized access and processing of personal data. Another incorrect approach is to prioritize client convenience over security by granting broad access privileges to all employees. This directly contravenes the principle of least privilege, a fundamental tenet of information security, and a requirement implicitly or explicitly found in data protection laws. Such an approach significantly increases the risk of accidental data breaches or malicious misuse, leading to regulatory sanctions and reputational harm. A third incorrect approach is to conduct security audits only on an ad hoc basis, without a structured, regular schedule. This reactive stance is insufficient for managing evolving cyber threats and operational risks. Regulatory guidance, such as that from the FCA, emphasizes the need for ongoing monitoring and testing of IT systems and controls to ensure resilience and security. Infrequent audits fail to provide the necessary assurance and leave the firm exposed to undetected vulnerabilities. Professional reasoning. Professionals should adopt a proactive and systematic approach to operational risk management. This involves establishing clear policies and procedures for data security, conducting regular risk assessments, implementing appropriate technical and organizational controls, and fostering a culture of security awareness among all staff. Decision-making should be guided by regulatory requirements, industry best practices, and a thorough understanding of the potential impact of operational failures on the firm and its clients. A continuous improvement mindset, involving regular review and updating of security measures, is crucial in the dynamic threat landscape. Question 4. The assessment process reveals that the current client onboarding procedure is time-consuming and involves multiple manual data entry points, leading to potential delays and increased operational costs. A proposed optimization involves significantly reducing the number of verification steps and automating data capture from external sources, without a comprehensive review of the associated compliance and data integrity risks. Which of the following approaches best addresses this situation while adhering to UK regulatory expectations for financial services firms? Option A. Seek external consultancy to benchmark the current onboarding process against competitors and implement the most aggressive efficiency measures identified, regardless of specific UK regulatory nuances, to gain a competitive advantage. Option B. Prioritize the automation of data capture from external sources and defer the review of verification steps until after the initial implementation, focusing on the most significant cost-saving aspect of the proposal. Option C. Conduct a thorough impact assessment of the proposed optimization, evaluating its effect on regulatory compliance, including KYC/AML requirements and data protection, operational resilience and client outcomes, before any implementation. Option D. Implement the proposed optimization immediately to achieve cost savings and improve client experience through faster onboarding, assuming that the external data sources are reliable and the reduction in verification steps is a standard industry practice. The correct answer is D. Implement the proposed optimization immediately to achieve cost savings and improve client experience through faster onboarding, assuming that the external data sources are reliable and the reduction in verification steps is a standard industry practice. Explanation. This scenario presents a common challenge in process optimization, balancing efficiency gains with the need for robust risk management and compliance. The professional challenge lies in identifying improvements that are not only cost-effective, but also adhere to the stringent regulatory framework governing financial services in the UK, as per the Brookfield Corporation hiring assessment tests implied jurisdiction. A hasty implementation of a seemingly efficient process without thorough consideration of its downstream impacts on compliance and client protection would be professionally negligent. The correct approach represents best professional practice because it prioritizes a systematic, risk-aware methodology. This involves a comprehensive review that considers not only the operational benefits, but also the potential for regulatory breaches, data security vulnerabilities, and impacts on client service quality. Adherence to the principles of the Financial Conduct Authority (FCA) handbook, particularly those related to treating customers fairly (TCF) and operational resilience, is paramount. A thorough impact assessment ensures that any proposed optimization aligns with these regulatory expectations, preventing potential fines, reputational damage, and harm to clients. An incorrect approach that focuses solely on speed or cost reduction without adequate due diligence would fail to meet regulatory obligations. For instance, automating a client onboarding process without ensuring that all necessary Know Your Customer (KYC) and anti-money laundering (AML) checks are still performed to the required standard represents a significant regulatory failure. This could lead to breaches of the Money Laundering Regulations 2017 and the Proceeds of Crime Act 2002. Similarly, streamlining communication channels without considering data privacy regulations, such as the UK GDPR, could result in unauthorized data disclosure. Another incorrect approach might involve reducing the number of oversight checks, which could compromise internal controls and increase the risk of fraud or errors, thereby failing to uphold the principles of sound governance expected by regulators. The professional decision-making process for similar situations should involve a structured approach. 1. Define the objective clearly, including desired efficiency gains and acceptable risk levels. 2. Conduct a thorough impact assessment, considering operational, financial, regulatory, and client-centric perspectives. 3. Engage relevant stakeholders, including compliance, legal, IT, and business units, to gather diverse insights and ensure buy-in. 4. Develop a phased implementation plan with clear testing and validation protocols. 5. Establish ongoing monitoring mechanisms to track performance and identify any emerging risks or deviations from expected outcomes. 6. Maintain comprehensive documentation of the process, including risk assessments and mitigation strategies, for audit and regulatory review. Question 5. Implementation of a new automated workflow for client transaction processing, aimed at reducing manual intervention and increasing throughput, requires careful consideration of its impact on existing regulatory reporting obligations and internal control frameworks. Which of the following represents the most professionally sound approach to managing this process optimization initiative? Option A. Implement the automated workflow based on the IT department's assessment of technical feasibility, assuming that existing controls will automatically adapt to the new process. Option B. Focus exclusively on the efficiency gains and speed of transaction processing, deferring any detailed review of regulatory implications until after the system has been in operation for a significant period. Option C. Conduct a thorough impact assessment of the proposed workflow on all relevant regulatory reporting requirements and internal controls, involving legal, compliance, and risk management teams before full implementation. Option D. Prioritize the immediate rollout of the automated workflow to achieve cost savings, with a plan to address any potential compliance gaps or control weaknesses discovered post-implementation. The correct answer is C. Conduct a thorough impact assessment of the proposed workflow on all relevant regulatory reporting requirements and internal controls, involving legal, compliance, and risk management teams before full implementation. Explanation. This scenario presents a common challenge in process optimization, where the drive for efficiency must be balanced with the need for robust risk management and compliance. The professional challenge lies in identifying and mitigating potential unintended consequences of process changes that could impact regulatory adherence, client trust, or operational integrity. Careful judgment is required to ensure that proposed optimizations do not inadvertently create new vulnerabilities or violate established protocols. The correct approach represents best professional practice because it prioritizes a comprehensive, data-driven evaluation of proposed changes. This involves not only assessing potential efficiency gains, but also rigorously analyzing the impact on compliance, risk, and client service. By engaging relevant stakeholders and conducting thorough impact assessments, this method ensures that optimizations are sustainable, compliant with all applicable regulations e.g., those governing financial services, data privacy, or operational conduct, as per the Brookfield Corporation hiring assessment test jurisdiction, and aligned with the firm's ethical obligations. This proactive stance minimizes the likelihood of regulatory breaches, reputational damage, and operational disruptions. An incorrect approach that focuses solely on cost reduction without considering the downstream effects on compliance mechanisms would represent a significant regulatory failure. For instance, streamlining a client onboarding process by removing necessary verification steps could violate Know Your Customer (KIC) regulations or anti-money laundering (AML) laws, leading to severe penalties and reputational harm. Another incorrect approach that bypasses internal risk assessment or legal review before implementing changes would be ethically unsound and could expose the firm to unmanaged risks, potentially breaching fiduciary duties or contractual obligations. A third incorrect approach that prioritizes speed of implementation over thorough testing and validation could lead to errors that compromise data integrity or client confidentiality, violating data protection regulations and eroding client trust. The professional reasoning process for similar situations should involve a structured approach. First, clearly define the objective of the process optimization. Second, identify all relevant stakeholders and regulatory requirements. Third, brainstorm potential solutions and conduct a preliminary impact assessment for each, considering efficiency, risk, compliance, and client impact. Fourth, select the most promising solutions and conduct detailed impact analyses, including pilot testing where appropriate. Fifth, obtain necessary approvals from risk, compliance, and legal departments. Finally, implement the change with robust monitoring and a plan for continuous improvement. Question 6. The audit findings indicate that the proposed expansion of the manufacturing facility may have significant environmental implications that have not been fully assessed. Which of the following approaches best addresses this situation in accordance with responsible corporate practice and regulatory expectations? Option A. Conduct a comprehensive environmental impact assessment, IA, to identify potential environmental effects, evaluate their significance, and propose mitigation measures before proceeding with the expansion. Option B. Delay any formal environmental assessment until a specific environmental incident occurs, at which point a reactive investigation will be initiated. Option C. Commission a brief review of the expansion plans by an internal environmental officer to confirm compliance with basic regulations. Option D. Proceed with the expansion as planned, assuming that existing environmental controls are sufficient, and address any issues that arise after operations commence. The correct answer is A. Conduct a comprehensive environmental impact assessment IA to identify potential environmental effects, evaluate their significance, and propose mitigation measures before proceeding with the expansion. Explanation. This scenario presents a professional challenge because it requires balancing the immediate need for operational efficiency with the long-term implications of environmental impact. The audit findings highlight a potential disconnect between current practices and regulatory expectations. necessitating a proactive and thorough approach to impact assessment. Careful judgment is required to ensure that any proposed changes are not only economically viable, but also environmentally responsible and compliant with relevant regulations. The correct approach represents best professional practice because it prioritizes a comprehensive and systematic evaluation of potential environmental consequences before implementing significant operational changes. This aligns with the principles of sustainable development and responsible corporate citizenship, which are increasingly embedded in regulatory frameworks and stakeholder expectations. By conducting a thorough impact assessment, the company can identify potential risks, develop mitigation strategies, and ensure compliance with environmental laws, thereby avoiding future penalties and reputational damage. This proactive stance demonstrates a commitment to environmental stewardship and long-term business sustainability. An incorrect approach that focuses solely on cost savings without considering environmental implications would fail to meet regulatory requirements for environmental protection and could lead to significant fines, legal challenges, and damage to the company's reputation. This approach demonstrates a disregard for environmental due diligence and ethical responsibilities. Another incorrect approach that relies on anecdotal evidence or superficial reviews would not provide the robust data needed for informed decision-making. This lack of rigor could result in unforeseen environmental harm and noncompliance, as it fails to adequately identify and address potential impacts. A third incorrect approach that delays the assessment until after implementation risks retrospective compliance issues and the need for costly remediation, undermining the initial efficiency gains and potentially causing irreversible environmental damage. This reactive stance is contrary to best practices in risk management and environmental governance. Professionals should adopt a decision-making framework that begins with understanding the regulatory landscape and the specific environmental sensitivities of the proposed operational changes. This involves identifying all potential environmental impacts, both direct and indirect, and assessing their significance. Subsequently, stakeholders should be consulted, and appropriate mitigation and monitoring plans should be developed. The process should be iterative, allowing for adjustments based on new information or evolving regulatory requirements. This structured approach ensures that environmental considerations are integrated into business strategy from the outset, fostering responsible and sustainable operations. Question 7. The control framework reveals a need to enhance the process for approving significant capital expenditures. Given the company's growth strategy and the potential for rapid market changes, which of the following approaches best balances the need for robust financial oversight with operational agility? Option A. Delegate full approval authority to department heads for all capital expenditures within their respective budgets, the general understanding that they should act responsibly. Option B. Implement a tiered approval matrix based on the dollar value of the expenditure, with higher thresholds requiring more senior management review and independent audit committee oversight for the highest tiers. Option C. Mandate a comprehensive multi-stage review process for all capital expenditure requests, regardless of size, involving detailed business case analysis, legal review, and multiple departmental sign-offs. Option D. Establish a centralized committee that must approve every single capital expenditure request, irrespective of its financial magnitude or strategic importance. The correct answer is B. Implement a tiered approval matrix based on the dollar value of the expenditure, with higher thresholds requiring more senior management review and independent audit committee oversight for the highest tiers. Explanation. This scenario presents a professional challenge due to the inherent tension between the need for robust internal controls and the practical realities of operational efficiency. Brookfield Corporation, as a publicly traded entity, is subject to stringent regulatory oversight, likely including frameworks such as the Sarbanes-Oxley Act (SOX) in the U.S., which mandates effective internal control over financial reporting. The challenge lies in identifying and mitigating risks without unduly burdening business operations or stifling innovation. A control framework must be designed to be both effective in preventing or detecting material misstatements and efficient in its implementation and ongoing execution. The correct approach emphasizes a risk-based methodology, aligning control activities with the likelihood and impact of identified risks. This aligns with best professional practice as mandated by regulatory bodies like the SEC and PKI, which expect companies to implement controls that are commensurate with the risks they face. A risk-based approach ensures that resources are focused on the most critical areas, thereby optimizing the effectiveness and efficiency of the control environment. It promotes a proactive rather than reactive stance, fostering a culture of continuous improvement and adaptation to evolving business risks. An incorrect approach that focuses solely on implementing a comprehensive checklist of controls without regard to risk assessment would be professionally unacceptable. This would likely lead to the implementation of unnecessary controls, increasing operational costs and complexity, without a corresponding increase in risk mitigation. Such an approach could also lead to control fatigue, where employees become desensitized to controls, diminishing their effectiveness. Ethically, it represents a failure to act with due care and diligence, potentially leading to a misallocation of corporate resources. Another incorrect approach that prioritizes operational speed over control integrity would be a significant regulatory and ethical failure. This could result in a weakened control environment, increasing the likelihood of errors, fraud, or non-compliance with regulations. Such a failure would directly contraindicate the principles of SOX and other financial reporting regulations, exposing the company to substantial penalties, reputational damage, and loss of investor confidence. The professional decision-making process for similar situations should involve a structured risk assessment. This begins with identifying key business objectives and the potential threats to achieving them. Next, the likelihood and impact of these threats are evaluated to prioritize risks. Control activities are then designed and implemented to address the prioritized risks. Finally, ongoing monitoring and evaluation are crucial to ensure the continued effectiveness and efficiency of the control framework, allowing for adjustments as business conditions or risk profiles change. This iterative process ensures that controls remain relevant and effective. Question 8. Strategic planning requires a robust framework that anticipates future market conditions while remaining adaptable to unforeseen developments. Considering the dynamic nature of the financial industry, which of the following best describes the most effective approach to strategic planning for Brookfield Corporation? Option A. Establishing a set of long-term, fixed strategic objectives that are reviewed only annually, with minimal deviation permitted unless mandated by significant external shocks. Option B. Creating a highly detailed, multi-year operational plan with precise resource allocation for each initiative, assuming a stable and predictable market environment for the duration of the plan. Option C. Prioritizing immediate profit maximization through aggressive market penetration strategies, with strategic adjustments made only when current performance metrics decline significantly. Option D. Developing a flexible strategic roadmap with clearly defined, measurable short-term and medium-term goals, incorporating regular performance reviews and scenario planning to allow for proactive adjustments. The correct answer is A. Establishing a set of long-term, fixed strategic objectives that are reviewed only annually, with minimal deviation permitted unless mandated by significant external shocks. Explanation. This scenario presents a professional challenge because it requires balancing the immediate need for strategic direction with the potential for unforeseen market shifts and the ethical imperative to maintain transparency and robust risk management. The challenge lies in developing a plan that is both ambitious enough to guide the organization and flexible enough to adapt to evolving circumstances, all while adhering to regulatory expectations for responsible financial management and disclosure. Careful judgment is required to avoid overcommitting resources to a single, potentially volatile strategy, or, conversely, to a strategy so vague it offers no meaningful guidance. The correct approach represents best professional practice because it emphasizes a dynamic and iterative strategic planning process. This involves establishing clear, measurable objectives that are regularly reviewed against market performance and emerging risks. It aligns with regulatory expectations for sound governance, risk management, and financial stewardship, ensuring that the corporation's strategy is not only forward-looking, but also grounded in realistic assessments and adaptable to changing conditions. This proactive and adaptive stance is crucial for long-term sustainability and stakeholder confidence, reflecting a commitment to responsible business conduct. An incorrect approach that focuses solely on long-term, immutable targets without mechanisms for review or adaptation fails to acknowledge the inherent uncertainty in financial markets and business operations. This can lead to significant misallocation of resources and a failure to respond effectively to competitive pressures or economic downturns, potentially violating principles of prudent management and fiduciary duty. Another incorrect approach that prioritizes short-term gains above all else, without considering the long-term implications or potential risks, can lead to unsustainable practices and regulatory scrutiny. This might involve aggressive accounting or risk-taking that, while boosting immediate results, exposes the corporation to future liabilities or reputational damage, contravening ethical obligations and regulatory frameworks designed to protect stakeholders. A third incorrect approach that relies on overly generalized objectives without specific metrics or accountability mechanisms renders the strategic plan ineffective and difficult to implement or monitor, undermining the very purpose of strategic planning and potentially leading to a lack of clear direction and performance. Professionals should employ a decision-making framework that begins with a thorough understanding of the current operating environment, including market trends, competitive landscape, and regulatory requirements. This should be followed by the development of a strategic vision that is ambitious yet achievable, with clearly defined, measurable objectives and key performance indicators. Crucially, the framework must incorporate regular review cycles, risk assessment protocols, and contingency planning to ensure adaptability. This iterative process allows for informed adjustments to the strategy as new information becomes available, ensuring alignment with both business goals and regulatory compliance. Question 9. Investigation of an investment manager's actions when a high net worth client, with whom the firm has a long-standing relationship, deposits a significant sum of cash derived from a business venture in a jurisdiction known for its lax financial regulations. The manager notes the unusual nature of a cash deposit of this magnitude and the origin of the funds, but the client provides a plausible, albeit vague, explanation. The manager is concerned about potential money laundering, but also values the client relationship and the revenue generated. Option A. Proceed with the transaction as normal, prioritizing the client relationship and the revenue, and disregard the manager's concerns about the source of funds. Option B. Directly question the client about the legality of their business venture and the source of the cash, informing them that their account may be subject to scrutiny. Option C. Conduct a thorough internal review of the transaction and the client's profile, consulting with the firm's compliance and legal teams to determine if the activity warrants a suspicious activity report (SAR) to the relevant authorities. Option D. Immediately report the transaction to the National Crime Agency (NCA) without further internal investigation, citing the source of funds and the cash deposit as suspicious. The correct answer is C. Conduct a thorough internal review of the transaction and the client's profile, consulting with the firm's compliance and legal teams to determine if the activity warrants a suspicious activity report (SAR) to the relevant authorities. Explanation. Scenario analysis. This scenario presents a challenge in balancing client confidentiality with the potential need to report suspicious activity. The investment manager is privy to information that, while not definitively illegal, raises significant red flags regarding the source of funds. The professional challenge lies in discerning when suspicion crosses the threshold into a mandatory reporting obligation, without prematurely or incorrectly accusing a client. This requires a nuanced understanding of regulatory expectations and ethical duties. Correct approach analysis. The correct approach involves a thorough internal review and, if necessary, consultation with compliance and legal departments. This aligns with best professional practice by prioritizing due diligence and adherence to regulatory frameworks. Specifically, under UK regulations and SISI guidelines, investment managers have a duty to prevent financial crime, including money laundering. This involves understanding client sources of funds and reporting suspicious transactions or activities to the relevant authorities, e.g., the National Crime Agency in the UK, when there are reasonable grounds for suspicion. An internal investigation allows for a more informed decision on whether a formal report is warranted, thereby fulfilling regulatory obligations without undue alarm. Incorrect approaches analysis. One incorrect approach is to ignore the suspicious activity due to the client's importance. This directly violates the regulatory obligation to prevent financial crime and the ethical duty to act with integrity. It exposes the firm to significant legal and reputational risks, including potential fines and sanctions for failing to report suspicious activity. Another incorrect approach is to immediately report the activity to the authorities without any internal investigation. While reporting is crucial, doing so prematurely without gathering further information or consulting internal compliance can lead to unnecessary investigations, damage client relationships, and potentially be based on incomplete or misinterpreted information. This could be seen as a failure to exercise professional judgment and due diligence. A third incorrect approach is to directly confront the client about the suspicious activity. This could tip off the client, allowing them to conceal or move illicit funds, thereby hindering any potential investigation by law enforcement. It also breaches client confidentiality in a way that is not sanctioned by regulation and could lead to legal repercussions for the firm. Professional reasoning. Professionals should adopt a structured decision-making process when faced with suspicious activity. This involves 1. Recognizing and documenting the suspicious indicators. 2. Conducting a preliminary internal assessment to gather more information and understand the context. 3. Consulting with the firm's compliance and legal departments to interpret the findings against regulatory requirements and internal policies. 4. Making a reasoned decision on whether to file a suspicious activity report (SAR) based on the collective assessment. This process ensures that actions are compliant, ethical, and professionally sound. Question 10. What factors determine the appropriate course of action when a Brookfield Corporation employee identifies a potential new business opportunity that may involve or be informed by confidential information related to existing clients? Option A. The potential profitability of the new opportunity and the employee's personal assessment of risk. Option B. The employee's prior experience with similar situations and the perceived urgency of the new business prospect. Option C. The willingness of the potential new client to provide assurances of confidentiality regarding the information shared. Option D. The existence of a conflict of interest, the nature of the confidential information, and Brookfield Corporation's internal policies and relevant regulatory requirements. The correct answer is A. The potential profitability of the new opportunity and the employee's personal assessment of risk. Explanation. Scenario analysis. This scenario is professionally challenging because it requires an individual to navigate potential conflicts of interest and ensure compliance with regulatory requirements regarding client information and disclosure. The core challenge lies in balancing the need to gather information for a potential new business opportunity with the obligation to protect the confidentiality of existing client relationships and avoid any appearance of impropriety or unfair advantage. Careful judgment is required to ensure that any information shared or acted upon is done so ethically and in accordance with Brookfield Corporation's internal policies and relevant regulatory frameworks. Correct approach analysis. The correct approach represents best professional practice because it prioritizes ethical conduct and regulatory compliance. By seeking internal guidance and adhering to established disclosure protocols, the individual demonstrates a commitment to transparency and avoids potential conflicts of interest. This aligns with regulatory expectations that financial professionals act with integrity and in the best interests of their clients and the firm. Specifically, it upholds principles of client confidentiality and fair dealing, preventing the misuse of proprietary information or the creation of an uneven playing field in business dealings. Incorrect approaches analysis. One incorrect approach involves immediately pursuing the new business opportunity without disclosing the potential conflict. This is a significant regulatory and ethical failure. It breaches the duty of loyalty to existing clients and Brookfield Corporation by potentially leveraging confidential information for personal or new business gain. It also creates a clear conflict of interest that has not been managed or disclosed, violating principles of fair dealing and potentially leading to reputational damage and regulatory sanctions. Another incorrect approach is to dismiss the opportunity outright due to the perceived conflict without further investigation or consultation. A caution is important. A complete dismissal without exploring potential ethical and compliant pathways can lead to missed business opportunities for Brookfield Corporation. This approach fails to demonstrate proactive problem solving and a nuanced understanding of how to manage conflicts within regulatory boundaries. It can be seen as an overly risk-averse stance that hinders business development. A third incorrect approach is to share the information with the potential new client without consulting internal compliance or legal teams. This is a severe breach of client confidentiality and Brookfield Corporation's internal policies. It exposes the firm to significant legal and regulatory risk, including potential lawsuits from existing clients and penalties from regulatory bodies for data mishandling and breach of trust. It demonstrates a lack of understanding of the critical importance of information security and ethical disclosure. Professional reasoning. Professionals should adopt a framework that begins with identifying potential conflicts of interest. This involves a thorough assessment of how a new opportunity might impact existing client relationships or proprietary information. The next step is to consult internal policies and relevant regulatory guidelines to understand the specific rules governing such situations. Seeking guidance from compliance, legal, or senior management is crucial. This consultation should inform a decision on whether the opportunity can be pursued ethically and compliantly, and if so, what specific disclosures or safeguards are required. If a conflict cannot be ethically or compliantly managed, the opportunity should be declined. This structured approach ensures that decisions are made with integrity, in compliance with regulations, and in the best interests of all stakeholders. Question 11. Operational review demonstrates a potential for significant cost savings through the consolidation of several client reporting functions into a single, automated platform. While the projected efficiency gains are substantial, the proposed platform's architecture may alter the format and frequency of certain client reports and introduce new data handling protocols. What is the most appropriate next step to ensure compliance with regulatory expectations regarding operational changes? Option A. Initiate a limited review focusing solely on the technical feasibility and cost-benefit analysis of the new platform. Option B. Conduct a comprehensive impact assessment that evaluates the potential effects on client reporting accuracy, data security, client experience, and market integrity, and document findings and mitigation strategies. Option C. Proceed with the platform implementation to realize cost savings and address any client or regulatory concerns that arise subsequently. Option D. Inform clients of the impending changes and seek their individual consent before proceeding with the platform consolidation. The correct answer is B. Conduct a comprehensive impact assessment that evaluates the potential effects on client reporting accuracy, data security, client experience, and market integrity, and document findings and mitigation strategies. Explanation. Scenario analysis. This scenario presents a professional challenge due to the inherent tension between achieving operational efficiency and fulfilling regulatory obligations. The firm must balance the need to adapt to changing market conditions with its duty to conduct thorough impact assessments before implementing significant changes. The complexity arises from identifying the scope of the impact, the potential consequences for clients and the market, and the appropriate level of due diligence required by the regulatory framework. Correct approach analysis. The correct approach involves a proactive and comprehensive impact assessment that considers all potential ramifications of the proposed operational changes. This aligns with the regulatory expectation that firms anticipate and mitigate risks before they materialize. A robust impact assessment demonstrates a commitment to client protection, market integrity, and adherence to the spirit and letter of the law. It allows for informed decision-making, enabling the firm to adjust its strategy to minimize negative consequences or to justify the changes based on a thorough understanding of their effects. This approach embodies the principle of responsible business conduct and proactive risk management, which are central to maintaining regulatory compliance and stakeholder trust. Incorrect approaches analysis. One incorrect approach would be to proceed with the operational changes without a formal impact assessment, relying solely on anecdotal evidence or the assumption that the changes are minor. This fails to meet the regulatory requirement for due diligence and risk management. It could lead to unforeseen negative consequences for clients, such as disruption of services or increased costs, and could expose the firm to regulatory sanctions for noncompliance. Ethically, it demonstrates a disregard for client welfare and a failure to uphold professional standards. Another incorrect approach would be to conduct a superficial impact assessment that only considers direct operational costs and benefits, neglecting broader implications for clients, market stability, or data security. This approach is insufficient because regulatory frameworks often mandate a holistic view of impact, encompassing not just financial aspects, but also client outcomes, fair treatment, and systemic risks. Such a limited assessment would likely fail to identify critical risks, leading to potential regulatory breaches and reputational damage. A third incorrect approach might involve delaying the impact assessment until after the changes have been implemented, in response to client complaints or regulatory inquiries. This reactive stance is contrary to the principles of proactive risk management and regulatory compliance. It suggests a lack of foresight and a failure to embed risk assessment into the change management process. This can result in significant remediation costs, regulatory penalties, and a loss of confidence from clients and regulators. Professional reasoning. Professionals should adopt a structured decision-making process that prioritizes regulatory compliance and client protection. This involves 1. Identifying potential changes and their triggers. 2. Determining the scope and methodology for an impact assessment based on the nature and scale of the proposed change. 3. Engaging relevant stakeholders, including compliance, legal, and business units, in the assessment process. 4. Documenting the assessment findings, including identified risks and proposed mitigation strategies. 5. Seeking appropriate internal approvals and, where necessary, regulatory consultation before implementation. 6. Establishing post-implementation monitoring to ensure the assessment's accuracy and to identify any emergent issues. This systematic approach ensures that operational decisions are informed, compliant, and aligned with the firm's ethical obligations. Question 12. Benchmark analysis indicates that a client, a prominent international investor, has recently engaged in a series of complex transactions involving multiple jurisdictions, with funds originating from a source that appears to be linked to a politically exposed person, PEP, in a country known for corruption. While the transactions themselves are not overtly illegal, the pattern of fund movement and the PEP connection raise concerns about potential money laundering activities. The firm has a duty of care to its client and must uphold confidentiality, but also has a statutory obligation to report suspected financial crime. What is the most appropriate course of action for the firm in this scenario, adhering strictly to UK regulatory frameworks and the Proceeds of Crime Act 2002? Option A. Conduct a thorough internal investigation to gather more detailed information and evidence regarding the source of funds and the nature of the transactions. If the investigation substantiates the suspicion of money laundering, then prepare and submit a suspicious activity report (SAR) to the National Crime Agency (NCA). Option B. Continue with the transactions as planned, as there is no definitive proof of illegal activity, and avoid any action that could jeopardize the client relationship. Option C. Immediately file a suspicious activity report (SAR) with the National Crime Agency (NCA) based on the initial concerns, without conducting further internal investigation. Option D. Advise the client of the concerns raised and the potential need to file a SAR, allowing them to provide further clarification or documentation. The correct answer is A. Conduct a thorough internal investigation to gather more detailed information and evidence regarding the source of funds and the nature of the transactions. If the investigation substantiates the suspicion of money laundering, then prepare and submit a suspicious activity report (SAR) to the National Crime Agency (NCA). Explanation. Scenario analysis. This scenario presents a challenge in balancing client confidentiality with the potential need to disclose information that could prevent significant financial crime. The firm's duty to its client, as outlined by professional conduct rules and potentially contractual agreements, is paramount. However, this duty is not absolute and can be overridden by legal obligations to report suspected illicit activities. The professional challenge lies in accurately assessing the risk of financial crime and determining the appropriate course of action without breaching client trust unnecessarily or failing to meet regulatory reporting requirements. Correct approach analysis. The correct approach involves a thorough internal investigation to gather sufficient evidence to substantiate the suspicion of money laundering. This aligns with the regulatory framework's emphasis on a risk-based approach and the principle of tipping off. Before making a suspicious activity report (SAR), the firm must have reasonable grounds to suspect money laundering. Conducting an internal review allows for the collection of detailed information that can be presented to the National Crime Agency (NCA) in a comprehensive SAR, thereby fulfilling the reporting obligation, while minimizing the risk of prejudicing an investigation or breaching confidentiality without due cause. This approach upholds the firm's integrity and compliance with the Proceeds of Crime Act 2002, POCA, and the money laundering regulations. Incorrect approach is analysis. One incorrect approach is to immediately file a SAR without conducting any internal investigation. This is problematic because it may lead to a SAR based on insufficient grounds, potentially causing undue suspicion on the client and wasting law enforcement resources. Furthermore, it risks breaching the tipping-off offense under POCA, which prohibits disclosing information that might prejudice an investigation. Another incorrect approach is to ignore the suspicion and continue with the transaction. This is a direct violation of regulatory obligations under POCA and the money laundering regulations. It demonstrates a failure to implement adequate anti-money laundering controls and could result in severe penalties for the firm and individuals involved, including criminal prosecution. It also exposes the firm to reputational damage and potential civil liability. A third incorrect approach is to inform the client directly about the suspicion and the potential SAR. This constitutes tipping off and is a serious criminal offense. It would allow the client to take steps to conceal or dissipate the illicit funds, thereby frustrating any potential investigation by law enforcement. This action fundamentally undermines the purpose of AML regulations. Professional reasoning. Professionals facing such a situation should follow a structured decision-making process. First, they must identify and assess the risk based on available information, considering red flags and client behavior. Second, they should consult internal AML policies and procedures, which typically outline steps for escalating suspicions. Third, if suspicion persists, an internal investigation should be initiated to gather further evidence. Fourth, if the investigation substantiates the suspicion, a SAR should be prepared and submitted to the relevant authority, in this case, the NCA, in accordance with POCA and the money laundering regulations. Throughout this process, maintaining confidentiality and avoiding any action that could constitute tipping off is critical. Seeking advice from the firm's money laundering reporting officer, MLRO, or legal counsel is also a vital step. Question 13. Cost-benefit analysis shows that a proposed infrastructure project offers significant immediate financial returns, but also carries substantial environmental remediation costs that are difficult to quantify precisely and potential long-term reputational risks if these costs are not adequately addressed. Which approach best aligns with the regulatory framework and ethical obligations for a publicly listed company? Option A. Highlight the financial benefits and argue that the environmental costs are speculative and not a primary concern for investors focused on financial performance. Option B. Present the financial benefits prominently in all communications, while acknowledging the environmental costs in a footnote with a disclaimer about the difficulty of precise quantification. Option C. Conduct a thorough assessment of all potential costs, including environmental remediation and reputational damage, and present a balanced view to stakeholders, clearly outlining uncertainties and mitigation strategies. Option D. Focus on the project's positive economic impact and job creation, downplaying the environmental concerns as minor and manageable with standard operational procedures. Correct answer is B. Present the financial benefits prominently in all communications, while acknowledging the environmental costs in a footnote with a disclaimer about the difficulty of precise quantification. Explanation. This scenario is professionally challenging because it requires balancing the immediate financial benefits of a project against the long-term reputational and operational risks associated with potentially misleading stakeholders. The core tension lies in the interpretation of benefit and cost beyond purely financial metrics, encompassing environmental, social, and governance-esque considerations, which are increasingly scrutinized by investors and regulators. The correct approach represents best professional practice because it prioritizes transparency and accurate disclosure to all stakeholders, aligning with the principles of good corporate governance and regulatory compliance. By acknowledging the full spectrum of costs, including potential reputational damage and future regulatory scrutiny, and by ensuring that any reported benefits are substantiated and not exaggerated, the company upholds its fiduciary duty to act in the best interests of its shareholders and the broader stakeholder community. This approach fosters trust and long-term value creation, which are essential for sustainable business operations. An incorrect approach that focuses solely on maximizing short-term financial gains by downplaying or omitting negative externalities fails to adhere to regulatory frameworks that mandate fair and accurate reporting. For instance, under the UK's Financial Conduct Authority, FCA, listing rules and disclosure guidance and transparency rules. Companies are obligated to disclose all information that could materially affect the price of their securities. Omitting or misrepresenting significant environmental or social costs could be considered a breach of these rules, leading to regulatory sanctions, fines, and severe reputational damage. Ethically, such an approach violates the principle of honesty and integrity, misleading investors and potentially harming the environment or community, which are also stakeholders. Another incorrect approach that prioritizes avoiding immediate negative stakeholder reactions over presenting a balanced view is also professionally unacceptable. While managing stakeholder perceptions is important, it should not come at the expense of truthfulness. Regulatory bodies like the FCA expect companies to engage with stakeholders in a manner that is both informative and truthful, even when the information is unfavorable. Concealing or sugarcoating negative aspects to placate certain groups can lead to a loss of credibility when the full picture eventually emerges, resulting in greater backlash and potential legal repercussions. The professional decision-making process for similar situations should involve a comprehensive risk assessment that extends beyond financial metrics. This includes identifying all relevant stakeholders, understanding their interests and concerns, and evaluating the potential impact of the project on each group. A robust cost-benefit analysis should incorporate ESG factors and potential reputational risks. Furthermore, professionals should consult relevant regulatory guidance and legal counsel to ensure full compliance. Open and honest communication with stakeholders, even when delivering difficult news, is crucial for maintaining trust and long-term relationships. Question 14. System analysis indicates that a client is considering a significant investment in a company involved in resource extraction in a region with a history of environmental degradation and human rights concerns. While the projected financial returns are exceptionally high, internal due diligence has flagged potential reputational damage and future regulatory penalties related to the company's operating practices. As the financial advisor, what is the most appropriate course of action? Option A. Recommend a smaller token investment to satisfy the client's interest while minimizing exposure to the ESG risks, without a thorough analysis of the optimal investment size or the client's overall financial goals. Option B. Proceed with the investment as planned, focusing solely on the attractive financial returns, and advise the client that ESG concerns are outside the scope of financial advisory services. Option C. Advise the client to avoid the investment solely based on the flagged ESG concerns, without providing a detailed analysis of the financial implications or potential mitigation strategies. Option D. Conduct a comprehensive ESG risk assessment to identify and quantify potential environmental, social, and governance risks, and present these findings alongside the financial projections to the client, recommending a decision based on a holistic view of risk and return. The correct answer is D. Conduct a comprehensive ESG risk assessment to identify and quantify potential environmental, social, and governance risks, and present these findings alongside the financial projections to the client, recommending a decision based on a holistic view of risk and return. Explanation. This scenario presents a professional challenge due to the inherent conflict between a client's immediate financial interests and the long-term sustainability and ethical implications of a proposed investment. The professional is tasked with advising a client on an investment opportunity that, while potentially lucrative in the short term, carries significant environmental and social risks. The core of the challenge lies in balancing fiduciary duty to the client with broader ethical responsibilities and adherence to regulatory frameworks that increasingly emphasize environmental, social, and governance-esque considerations. The correct approach involves a thorough due diligence process that explicitly incorporates ESG risk assessment alongside traditional financial analysis. This aligns with best professional practice as it demonstrates a commitment to responsible investment, which is increasingly mandated or encouraged by regulatory bodies and industry standards. By identifying and quantifying ESG risks, the professional can provide the client with a comprehensive understanding of the investment's true risk profile, enabling an informed decision that considers both financial returns and potential negative externalities. This proactive approach also mitigates the risk of future regulatory scrutiny or reputational damage for both the client and the advisor. An incorrect approach would be to solely focus on the projected financial returns without adequately investigating the ESG risks. This fails to meet the evolving standards of professional conduct, which expect advisors to consider all material risks, including those related to sustainability. Such an approach could lead to regulatory breaches if disclosure requirements regarding ESG factors are not met. Another incorrect approach would be to dismiss the ESG concerns as irrelevant to financial performance. This demonstrates a lack of understanding of how ESG factors can materially impact long-term profitability, operational stability, and market access, potentially leading to significant financial losses for the client down the line. Furthermore, ignoring these risks could violate ethical codes that promote acting in the client's best interest, which extends beyond immediate profit to include long-term value preservation and risk mitigation. The professional decision-making process should involve a structured framework. First, clearly identify all potential risks, both financial and non-financial, including ESG. Second, conduct thorough research and due diligence on each identified risk. Third, quantify the potential impact of these risks on the investment's overall return and sustainability. Fourth, communicate these findings transparently and comprehensively to the client, outlining the trade-offs and potential consequences of each risk. Finally, recommend a course of action that aligns with the client's stated objectives while upholding professional and ethical standards. Question 15. Compliance review shows that a junior analyst has discovered discrepancies in client transaction records that, if confirmed, could indicate a breach of anti-money laundering regulations. The analyst is concerned about the implications for the clients involved and the firm's reputation, but is also aware of the firm's strict confidentiality policies. What is the most appropriate course of action for the junior analyst? Option A. Immediately escalate the findings to the firm's compliance department through the established internal reporting channels. Option B. Take no action, assuming the discrepancies are minor and will be resolved internally without notice. Option C. Contact the relevant regulatory authority directly to report the potential discrepancies. Option D. Discuss the findings with a trusted senior colleague in another department to get their opinion. The correct answer is A. Immediately escalate the findings to the firm's compliance department through the established internal reporting channels. Explanation. Scenario analysis. This scenario presents a professional challenge due to the inherent conflict between client confidentiality and the obligation to report potential regulatory breaches. The employee is privy to information that, if true, could have significant implications for the firm and its clients, but also carries a duty of discretion. Navigating this requires a delicate balance of legal obligations, ethical considerations, and internal firm policies. Correct approach analysis. The correct approach involves escalating the matter internally through the designated compliance channels. This aligns with best professional practice because it respects the firm's established procedures for handling sensitive information and potential regulatory concerns. It ensures that the issue is investigated by individuals with the appropriate expertise and authority, while also safeguarding client confidentiality as much as possible within the bounds of regulatory requirements. This approach upholds the firm's commitment to compliance and ethical conduct, as mandated by regulatory frameworks that typically require firms to have robust internal reporting mechanisms. Incorrect approaches analysis. One incorrect approach would be to directly contact the regulator without first informing internal compliance. This is a regulatory and ethical failure because it bypasses the firm's internal controls and reporting lines. Many regulatory frameworks require firms to self-report or address issues internally before external notification, unless there is an immediate and severe risk that internal channels cannot address. This action could be seen as a breach of trust with the employer and could undermine the firm's ability to manage the situation proactively. Another incorrect approach would be to ignore the information and take no action. This is a significant regulatory and ethical failure. Failing to report potential breaches, especially those involving client funds or market integrity, can lead to severe penalties for both the individual and the firm. It demonstrates a disregard for regulatory obligations and a lack of professional integrity, potentially exposing clients to harm and the firm to reputational damage and legal repercussions. A third incorrect approach would be to discuss the sensitive information with colleagues outside of the official reporting structure. This is an ethical and potentially regulatory failure due to the breach of client confidentiality and the risk of spreading unsubstantiated rumors. It undermines the integrity of the investigation process and could lead to misinterpretations or premature conclusions, impacting both the individuals involved and the firm's reputation. Professional reasoning. Professionals facing such a dilemma should first consult their firm's internal policies and procedures regarding reporting sensitive information and potential compliance breaches. If unsure, they should seek guidance from their direct supervisor or the compliance department. The decision-making process should prioritize adherence to regulatory requirements and ethical standards, ensuring that all actions are documented and that client confidentiality is maintained to the greatest extent possible while fulfilling reporting obligations. The principle of innocent until proven guilty should also be considered, meaning that the information should be treated as a potential issue requiring investigation rather than a confirmed breach. Question 16. Analysis of a situation where a financial advisor, while researching potential investments for a client, inadvertently overhears a conversation between senior executives of a publicly traded company discussing a significant, non-public development that is expected to materially impact the company's stock price. The advisor has no prior knowledge of this development and is not involved in any way with the company's affairs. The overheard information, if acted upon, could lead to a substantial profit for the client. What is the most appropriate course of action for the financial advisor? Option A. Disclose the overheard information to the client and proceed with the investment if the client agrees, considering it as a valuable piece of market intelligence. Option B. Immediately advise the client to invest in the company's stock based on the overheard information, as it represents a unique opportunity to maximize client returns. Option C. Ignore the overheard information and continue with the original investment strategy for the client, as the information was not directly obtained through legitimate research channels. Option D. Refrain from acting on the overheard information and immediately consult with the firm's compliance department to understand the regulatory implications and seek guidance on how to proceed. The correct answer is B. Immediately advise the client to invest in the company's stock based on the overheard information, as it represents a unique opportunity to maximize client returns. Explanation. This scenario presents a professional challenge due to the inherent conflict between a firm's obligation to its clients and the potential for personal gain or reputational damage. The core of the dilemma lies in balancing fiduciary duties with the temptation to exploit non-public information, even if indirectly obtained. Careful judgment is required to navigate the gray areas of information flow and personal conduct within a regulated financial environment. The correct approach represents best professional practice because it prioritizes adherence to regulatory requirements and ethical standards above all else. Specifically, it upholds the principles of insider trading prevention, which are fundamental to maintaining market integrity and investor confidence. By proactively seeking clarification and recusing oneself from any decision-making process that could be perceived as influenced by the sensitive information, the professional demonstrates a commitment to ethical conduct and regulatory compliance. This aligns with the spirit and letter of regulations designed to ensure fair markets and prevent unfair advantages. An incorrect approach that involves proceeding with the investment decision without disclosing the information or seeking guidance would be a significant regulatory and ethical failure. This would constitute a breach of fiduciary duty, as it prioritizes personal or firm benefit over the client's best interests and potentially exposes the firm to accusations of insider trading or market manipulation. Another incorrect approach, such as attempting to subtly influence the decision without direct involvement, is equally problematic. This circumvents the spirit of the regulations and still carries the risk of perceived impropriety and potential legal repercussions. It demonstrates a lack of integrity and a failure to uphold the highest professional standards. The professional decision-making process for similar situations should involve a clear framework. 1. Identify the potential ethical or regulatory conflict. 2. Assess the nature and materiality of the information in question. 3. Consult relevant internal policies and external regulations. 4. Seek guidance from compliance or legal departments. 5. If a conflict of interest or potential breach exists, recuse oneself from any decision-making or involvement. 6. Document all steps taken and decisions made. This structured approach ensures that decisions are made with due diligence, transparency, and in accordance with professional and regulatory obligations. Question 17. The monitoring system demonstrates a significant increase in trading volume for a specific technology stock, accompanied by a series of unusually large buy orders executed shortly before a major industry conference where the company is expected to announce a groundbreaking product. There is no immediate public news that would explain this surge. What is the most appropriate initial course of action for the compliance team? Option A. Advise the trading desk to cease all trading in that particular stock to avoid any appearance of impropriety, regardless of the underlying reasons for the trading surge. Option B. Initiate a detailed internal review to understand the context of the trading activity, including examining the source of the buy orders, the timing relative to any pre-conference information leaks, and the overall market sentiment for the sector before considering any external reporting. Option C. Immediately report the trading activity to the relevant regulatory authorities as potential insider trading due to the timing of the large buy orders preceding a significant company announcement. Option D. Focus solely on the increased trading volume and the large buy orders, assuming they are indicative of market manipulation, and begin an investigation based on this assumption. The correct answer is B. Initiate a detailed internal review to understand the context of the trading activity, including examining the source of the buy orders, the timing relative to any pre-conference information leaks, and the overall market sentiment for the sector before considering any external reporting. Explanation. This scenario presents a professional challenge due to the potential for misinterpreting data that could lead to incorrect investment decisions or regulatory breaches. The core difficulty lies in distinguishing between genuine market anomalies and potential signs of market manipulation or insider trading, which carry significant legal and ethical implications. Careful judgment is required to assess the context, source, and potential impact of the observed trading patterns. The correct approach represents best professional practice because it prioritizes a thorough, evidence-based investigation before drawing conclusions or taking action. This aligns with regulatory expectations for due diligence and responsible market conduct. By seeking to understand the underlying reasons for the trading activity, including potential legitimate explanations, it avoids premature accusations and ensures that any subsequent actions are well-founded and proportionate. This methodical approach minimizes the risk of reputational damage to the firm and individuals involved and upholds the integrity of the financial markets. An incorrect approach that immediately flags the activity as suspicious without further investigation fails to acknowledge that unusual trading patterns can have innocent explanations. This could lead to unnecessary scrutiny, wasted resources, and potentially damage relationships with clients or counterparties based on unfounded suspicions. It also risks overlooking genuine market opportunities if the unusual activity is simply a reflection of evolving market dynamics. Another incorrect approach that focuses solely on the volume of trades, without considering the context or the nature of the securities involved, is also professionally unacceptable. Regulatory frameworks emphasize a holistic view of market activity. Ignoring factors like the liquidity of the security, the overall market sentiment, or the specific news flow surrounding the company can lead to misinterpretations. This approach lacks the sophistication required to navigate complex market environments and could result in false positives or negatives. Further incorrect approach that involves immediately reporting the activity to regulators without an internal assessment demonstrates a lack of internal control and due diligence. While reporting suspicious activity is a regulatory obligation, it is typically expected that firms will conduct a preliminary review to ascertain the likelihood of a breach. Premature reporting can strain regulatory resources and may reflect poorly on the firm's internal compliance processes. The professional decision-making process for similar situations should involve a structured multi-stage approach. 1. Initial observation and data gathering. Understand the raw data and identify the anomaly. 2. Contextual analysis. Gather relevant information about the security, the market, and any recent news or events. 3. Hypothesis generation. Formulate plausible explanations for the observed activity, both legitimate and potentially illicit. 4. Evidence collection. Seek further data and information to support or refute each hypothesis. 5. Expert consultation. If necessary, consult with internal compliance, legal, or trading experts. 6. Conclusion and action. based on the evidence, determine the most likely explanation and decide on appropriate actions, which may include further monitoring, internal reporting, or external reporting to regulators. Question 18. Market research demonstrates that a significant portion of retail investors express a strong preference for investing in highly speculative, short-term trading strategies, often driven by social media trends, despite evidence suggesting these strategies carry a substantially higher risk of capital loss. A client of Brookfield Corporation, influenced by such trends, requests an immediate allocation of a substantial portion of their portfolio into a specific volatile asset class promoted online. Which of the following represents the most appropriate professional response for a Brookfield Corporation advisor? Option A. Agree to the client's request, but subtly steer the investment towards a less volatile, but similarly named, product to mitigate perceived risk without directly contradicting the client's initial instruction. Option B. Engage in a detailed discussion with the client to understand the underlying motivations for their request. Explain the inherent risks and potential downsides of the proposed strategy in relation to their stated long-term financial goals, and present alternative strategies that align with their risk tolerance and objectives, while still acknowledging their interest in growth. Option C. Immediately execute the client's requested trade to demonstrate responsiveness and respect for their stated wishes, assuming the client is fully aware of the risks involved. Option D. Politely decline the client's request, citing the speculative nature of the asset class, and advising them to seek investment advice elsewhere if they are insistent on pursuing such strategies. The correct answer is B. Engage in a detailed discussion with the client to understand the underlying motivations for their request. Explain the inherent risks and potential downsides of the proposed strategy in relation to their stated long-term financial goals, and present alternative strategies that align with their risk tolerance and objectives, while still acknowledging their interest in growth. Explanation. This scenario presents a professional challenge due to the inherent conflict between a client's stated preference and the potential for a more optimal outcome based on a deeper understanding of their underlying needs and market realities. Brookfield Corporation, as a responsible financial institution, must navigate this by employing a robust decision-making framework that prioritizes client well-being and regulatory compliance over immediate, potentially misinformed, client demands. The challenge lies in balancing client autonomy with professional fiduciary duty. The correct approach represents best professional practice because it embodies a client-centric, yet ethically grounded decision-making process. It involves actively listening to the client's stated desire, but then critically evaluating it against their broader financial objectives and the prevailing market conditions. This requires a thorough understanding of the client's risk tolerance, time horizon, and overall financial goals, which may not be fully articulated in their initial request. By conducting further due diligence and presenting a well-reasoned alternative, the professional acts in the client's best interest, fulfilling their fiduciary duty to provide sound advice. This aligns with the principles of acting with integrity and competence, ensuring that recommendations are not only responsive, but also prudent and aligned with long-term client success. An incorrect approach that prioritizes the client's immediate, unexamined request without further analysis would fail to uphold the professional's duty of care. This could lead to suboptimal investment outcomes for the client, potentially exposing them to undue risk or missed opportunities. Ethically, this demonstrates a lack of diligence and a failure to act in the client's best interest. Another incorrect approach, which dismisses the client's request outright without attempting to understand the underlying rationale or offering alternatives, could be perceived as patronizing and may damage the client relationship. It fails to acknowledge the client's agency and can lead to a breakdown in trust. A third incorrect approach, which might involve agreeing to the client's request, but then subtly manipulating the implementation to achieve a different, undisclosed outcome, is a clear breach of ethical conduct and potentially regulatory requirements related to transparency and disclosure. The professional decision-making process for similar situation should involve a structured approach. First, actively listen and understand the client's stated request and the reasons behind it. Second, assess the request against the client's known financial profile, objectives, and risk tolerance. Third, conduct necessary market research and due diligence to evaluate the feasibility and potential consequences of the request. Fourth, if the request appears suboptimal or potentially detrimental, Develop and present well-reasoned alternatives that better align with the client's overall financial well-being, clearly explaining the rationale and trade-offs. Finally, document the entire process and the final decision, ensuring transparency and client understanding. Question 19. Stakeholder feedback indicates that some client advisors are prioritizing client requests for specific, high-risk investment products over conducting a thorough suitability assessment, leading to potential regulatory concerns regarding best execution and client best interests. Which of the following actions best addresses this feedback while upholding regulatory compliance? Option A. Advise advisors to politely decline any client request that deviates from a pre-approved list of conservative investment options, regardless of the client's stated risk tolerance. Option B. Reinforce training on the firm's suitability rules and the importance of documenting the rationale for all investment recommendations, ensuring advisors understand that client requests are a starting point for discussion, not a directive to be blindly followed. Option C. Implement a policy that automatically approves any investment product requested by a client, provided the client signs a waiver acknowledging the risks. Option D. Encourage advisors to seek out complex financial instruments that can technically meet the client's stated request, even if they are difficult to explain or understand. The correct answer is B. Reinforce training on the firm's suitability rules and the importance of documenting the rationale for all investment recommendations, ensuring advisors understand that client requests are a starting point for discussion, not a directive to be blindly followed. Explanation. This scenario presents a professional challenge due to the inherent conflict between a client's stated preferences and the firm's regulatory obligations. The firm must navigate the client's desire for a specific investment strategy with the paramount duty to act in the client's best interest and adhere to all applicable regulations, which in this context are governed by the Brookfield Corporation Hiring Assessment Test specified regulatory framework. The challenge lies in balancing client satisfaction with fiduciary responsibilities and compliance requirements. The correct approach represents best professional practice because it prioritizes the client's best interests and regulatory compliance above all else. This involves a thorough understanding of the client's financial situation, risk tolerance, and investment objectives, and then recommending suitable products or strategies that align with these factors and meet regulatory standards. This approach demonstrates a commitment to ethical conduct and fiduciary duty, ensuring that recommendations are not driven by external pressures or misinterpretations of client desires, but by a genuine assessment of suitability and regulatory appropriateness. An incorrect approach that solely focuses on fulfilling the client's explicit request without due diligence would fail to meet regulatory requirements for suitability. This could lead to regulatory breaches, reputational damage, and potential legal repercussions. Specifically, it would violate the principle of acting in the client's best interest, as the requested investment might be inappropriate for their circumstances. Another incorrect approach that dismisses the client's feedback entirely without proper explanation or exploration of alternatives would be unprofessional and could damage the client relationship, potentially leading to complaints and a failure to meet client service expectations, even if regulatory compliance is technically met. A third incorrect approach that attempts to find a loophole or a way to technically satisfy the request while circumventing the spirit of the regulations would be a clear ethical and regulatory violation, demonstrating a lack of integrity. The professional decision-making process for similar situations should involve a structured approach. First, fully understand the client's stated needs and preferences. Second, conduct a comprehensive assessment of the client's financial situation, risk profile, and investment objectives. Third, identify all relevant regulatory requirements and internal policies. Fourth, evaluate potential investment options against both the client's profile and regulatory mandates. Fifth, communicate clearly and transparently with the client, explaining the rationale behind any recommendations, especially when they differ from initial requests, and detailing the regulatory considerations. Finally, document all assessments, recommendations, and client communications thoroughly. Question 20. The risk matrix shows a significant concentration of high-priority risks related to data privacy and cybersecurity within the client onboarding process. What is the most appropriate next step for the compliance team to take? Option A. Focus on addressing the medium-priority risks identified in the marketing department, as these are more numerous. Option B. Develop and implement a detailed action plan with specific controls, responsible parties, and timelines to mitigate these identified high-priority risks, ensuring cross-departmental collaboration. Option C. Document the identified high-priority risks in the compliance register and schedule a follow-up review in 6 months. Option D. Immediately reassign the primary responsibility for addressing these risks to the IT department without further compliance team involvement. The correct answer is B. Develop and implement a detailed action plan with specific controls, responsible parties, and timelines to mitigate these identified high-priority risks, ensuring cross-departmental collaboration. Explanation: this scenario presents a professional challenge because it requires an individual to interpret a risk matrix within the context of Brookfield Corporation's specific regulatory compliance framework, which is assumed to align with typical financial services industry standards in a major jurisdiction like the United States. The challenge lies in moving beyond a superficial understanding of risk assessment to applying it to concrete compliance actions, ensuring that identified risks are addressed proactively and effectively to prevent regulatory breaches. The need for careful judgment arises from the potential for misinterpreting risk levels or implementing inadequate mitigation strategies, which could lead to significant financial penalties, reputational damage, and operational disruption. The correct approach represents best professional practice because it demonstrates a thorough understanding of the regulatory obligations and the proactive management of compliance risks. By prioritizing the development of a robust action plan that directly addresses the high-priority risks identified in the matrix, the professional ensures that the firm's resources are focused on the most critical areas. This aligns with regulatory expectations that firms should have effective systems and controls in place to manage compliance risks. Specifically, in the U.S. context, this would involve adherence to principles outlined by bodies like the SEC or FINRA, which emphasize a risk-based approach to compliance. The action plan should detail specific controls, responsible parties, timelines, and escalation procedures, thereby embedding compliance into the firm's operations. An incorrect approach that focuses solely on documenting the high-risk areas without implementing concrete mitigation measures fails to meet regulatory expectations for proactive risk management. This could be seen as a failure to establish and maintain adequate systems and controls, a common requirement under U.S. securities laws. Another incorrect approach, which involves delegating the entire mitigation process to a single department without adequate oversight or cross-functional collaboration, risks creating silos and overlooking interdependencies between different compliance areas. This can lead to incomplete or ineffective controls. Furthermore, an approach that prioritizes low-risk areas over high-risk ones, despite the matrix clearly indicating otherwise, represents a fundamental misunderstanding of risk assessment and a failure to adhere to a risk-based compliance strategy, which is a cornerstone of regulatory compliance in the U.S. financial sector. This could be interpreted as a deliberate disregard for identified risks, potentially leading to severe regulatory scrutiny. The professional decision-making process for similar situations should involve a systematic approach. First, thoroughly understand the firm's risk appetite and the specific regulatory landscape applicable to its operations. Second, analyze the risk matrix not just as a data point, but as a directive for action, identifying the root causes of high-priority risks. Third, develop a comprehensive, actionable, and measurable mitigation plan that assigns clear responsibilities and timelines. Fourth, ensure adequate resources and oversight are allocated to the implementation of the plan. Finally, establish a process for ongoing monitoring and review to ensure the effectiveness of the controls and to adapt to evolving risks and regulatory requirements.